I would like to see gold continue to push higher, but overall, this is still the same thing. This is a big down move. This is a counter trend kind of play as price goes. So big volume on the down move. As price moves up, we've got lighter volume, meaning it's going up with fewer and fewer buyers are excited to pay this pricing, and then it could break to the downside. And sorry, I got a system firing off some trades, some spikes here. But overall, if we step back, it's a big mixed market right now for precious metals. It's a coin toss. The long-term trends for metals, the long-term trends are still up. Price is still intact above the 50-day. Taking a look at the charts, we got equities trading higher. We've got precious metals positive. We got oil up. We got money flowing into the markets. Now, if we look at the S&P 500 30-minute chart, we can kind of look back. We saw the market dip into an oversold territory. We saw a bout of panic selling. And we also saw a cycle low, which I showed yesterday on the daily chart. We have these series of cycle lows. And then we got that sharp rebound we talked about. And there was obviously the VIX had spiked right at this point as well. We saw the put call ratio spike. And I talked about how that usually leads to some type of relief bounce or the start of a new rally. And so we've had this very strong impulse move to the upside. Now, an impulse move, maybe I'll cover this in today's live mentoring session at 12 noon for when we go through all of this stuff, but an impulse move is a strong move in one direction that breaks at least two previous pivot highs. So if we were to just clear this chart, and we'll zoom in a little bit here, there's obviously a high right here. So this is one high and this is another high. Now, an impulse move is when you have a strong move that breaks through one high, one resistance level, and then breaks through a second one. And when you've broken through two ceilings, you obviously have some upward momentum. I always think of it, I learned this a long time ago when I was day trading, was you look for floors and ceilings. Think of every chart like an apartment building. You got a low here, you got a high here. You got another high here, you got another high here. These are all floors and ceilings, depending on what side you are on of those lines. And so if you are below this line over here and this line, obviously you're down on the ground floor. If you bust through that ceiling and keep going and break through two ceilings to the upside or three ceilings like we have in this chart, you got some pretty good momentum. And that is usually a trend change. So you want to break two previous highs with an impulse move. One move just shatters through two or more levels, and then any pause or pullback from there can be seen as an opportunity. So now we're waiting for the S&P 500 for this at this moment here to have some type of retracement, right? So if we grab the low, we use a fib retrace, we can say, okay, well, the sweet spot for the S&P 500 to pull back, we don't want it to pull back any further than this. It doesn't have to pull this far back. It could find support right here, which is pretty much where it broke this last high. Obviously, there's some big volatility. Some sellers stepped in, but then it busted through it. And now it's settling down. So it just needs to find support above this level, 6,900 or 6,927, somewhere in there. And then it can go higher. And depending where that is where we would then...
In technical analysis, strength is measured by how convincingly price breaks prior resistance. When markets clear one ceiling, momentum builds. When they break two or more in rapid succession, conviction strengthens further. The recent S&P rally accomplished precisely that. Now attention turns to the inevitable retracement. Healthy bull markets often pause, pulling back toward key Fibonacci retracement zones before extending higher. If support holds above recent breakout levels, the index could target fresh record highs. However, deeper pullbacks would reduce upside projections. The size and speed of this consolidation will determine whether momentum accelerates or begins to fade.
Then we could use our Fibonacci extension saying, okay, well, based on this low all the way up to this high, depending where this pullback comes to, it tells us where our upside targets are, right? So if it finds a bottom here today and starts moving higher, then we can squish the chart down a bit and we say, okay, well, based on this move, based on this rally up, I don't know why the tool is not drawing, based on this rally up and this pullback, this very tiny high, the less it pulls back, the more momentum it has, the more explosive it can be to the upside. And it also just happens to be how you get higher fib targets as well. Obviously, the more this pulls back, you'll notice these upper fib targets start to move down, right? So you lose some momentum and you lose upside targets. So the smaller the pullback and the quicker the pause, the more upside explosive move it has. And so based on that, we could see if the market does find a bottom today, we could see 70.85 and then potentially up to 71.64, which I think is all-time highs for the market, which it is. So that is kind of what this chart is potentially pointing to at this point. So we'll see how that unfolds. The NASDAQ is a very different story. It does have an impulse move, meaning it's broken 2 previous highs. It's got a series of, it's got this nice move, but you'll notice the bars are orange and they're red. They're nowhere near the highs, and it's lost a lot more momentum. And just the big tech has been struggling. Software's been struggling. AI is starting to wreak havoc in different spaces, as I mentioned in last night's update. We're starting to see that carry over into, tax, accounting stuff. It feels like every week now AI is poking its head into a new industry and just going to wreak havoc on a lot of businesses. Now, if we use the same here, we can say, okay, well, based on the low and this high, the NASDAQ should find support either anywhere above the 50%. This is the sweet spot, anywhere above 50%. We don't want it to go any lower than this. So as long as it finds support here, it still has a bullish pullback and pause. Now, if we want to look at where the NASDAQ could go based on the chart pattern, and if it finds a bottom this morning, you could see we've got an upside target of 25.70. We got 26.106, which will bring us up to these highs. I'm not sure if that's all-time highs or not quite, but it'll bring us right up into striking distance of all-time highs, pretty darn close. So there is some potential here. S&P 500 would hit all-time highs, get lots of traction, probably suck a lot more people into the market who don't have any skin in the game in equities. The NASDAQ will be hitting its head kind of on a triple top, right? We'd be coming back looking here, and we could say, well, based on that, we've got a high right here, we've got a high right here, and then this would come up and we'd have potentially another high over here at this level. So, that's not the most bullish sign. We kind of want the NASDAQ to be breaking out as well. It's a heavyweight, it's got the big stocks in it, but
while the S&P 500 appears technically constructive, the NASDAQ tells a more cautious story. Though it achieved an upside impulse move, momentum indicators remain weaker. Many large technology names are struggling to regain leadership. Artificial intelligence disruption, shifting capital flows, and valuation concerns are creating selective pressure within growth sectors. The index faces potential resistance near prior highs, forming what could evolve into a triple-top structure. A breakout would reignite optimism. Failure, however, could signal distribution. In markets, leadership matters, and when heavyweight sectors hesitate, broader indices often feel the strain shortly thereafter.
That's kind of where we are in terms of when we look at the short-term momentum of those charts. Now, yesterday or last few days, we've been seeing money flow into SPYD, which are the high-yield dividend stocks. Money's looking for protection. They're not running from the market. In fact, we got tons of shares, I think almost a record high shares being traded on the stock market. So there's a lot of volume going on, but it's a lot of changing hands. It's hard to tell if it doesn't feel like it's broad market buying. It feels like a lot of people are buying into the market, but I also feel like a lot of big money investors and funds are churning shares, meaning they're letting the markets hold up and move higher. There's a ton of volume, but prices aren't really expanding in general. And that means, I think, smart money, big money, is unloading, distributing, selling into the general public who are piling in to the stock market, and they're unloading their shares. If we look at the IWC, you can see there's been a ton of volume over the last couple of months. People moving into the small micro cap. People are getting very aggressive. We talked about this back over here when it was making these highs, how people are getting very, very bullish, which to me is a contrarian indicator in this kind of market environment. And I think big money is unloading and selling shares, getting rid of their risky stocks, getting rid of even the mega caps, which I think are actually risky stocks. Even though they're big and some of them pay dividends, they are, I think, very risky because they have mass psychology, has driven them to crazy, ludicrous pricing, and that can unwind. Just like in silver, it can get driven to ludicrous pricing and then be wiped out very quickly. The same people who drive it up and don't care about pricing, they have a bigger plan for it. They also jump ship and drive the price straight down very quickly once things do turn. So that's what we need to be aware of. Now let's take a look at where else money is flowing. Utilities up 1.6% this morning. We've been talking about how it's been carving out this what looks to be a bottom and finally really popped and really took off. And we saw that traction get there. You can see it was in a downtrend and turning neutral, and then finally really turned into an uptrend, dipped into a little bit of oversold, quickly got bought up, and then it's popped yesterday. So money's going to dividend stocks, utilities, and we also saw real estate, IYR. When people are nervous, they don't know what to do. Naturally, investors, real estate is pretty tough to beat long term. And so when people get nervous and don't know what to do, they also go to real estate. And so we're seeing people move into the REITs because they pay good dividends and it's a solid asset and you hold something. So that's kind of that. Now, if we take a look at the precious metal space, we do have gold. It was up really nicely this morning, up over 2%. It's recently just taken a bit of a hit. I think we've got some economic data or something coming out here. Just took a bit of a hit with some volume, but overall it's been drifting up, which is what I've been hoping and expecting we'd see.
Recent trading volume suggests significant capital rotation beneath headline strength. Dividend-focused ETFs, utilities, and real estate investment trusts are attracting renewed interest. These sectors typically outperform during periods of uncertainty, offering income stability over rapid growth. Simultaneously, smaller cap equities are seeing heavy activity, a sign of speculative participation. Historically, when enthusiasm expands into riskier corners of the market, it can indicate late-stage optimism. Large institutional investors often distribute shares into such strength. Elevated volume without broad price expansion may suggest that smart money is lightening exposure while retail enthusiasm remains elevated.
If we take a look over at silver, it was up about 7 or 8% this morning. It obviously just took a hit as well. Let's just take a look at SLV. So we're seeing a little bit of selling in the market. Let's just see what's going on with SPY and what's going on. So stocks have popped. I think we had jobs or something come out just a few minutes ago. So we got the stock market looking at it positive, and money's coming out of metals and moving into stocks at this point on the economic data. So we'll see how all this plays out by the end of the day. We do have platinum and palladium positive. Obviously, they are selling off too. They're all the same play. Miners could be doing much of the same thing. They could be starting to sell off and moving a bit lower in pre-market. They actually ran up in overnight trading. They're trading higher. They're going to gap higher and then potentially could sell off today. And if we look at GDX, it's kind of interesting, this chart. Look at our trend chart. So it's gone orange, it's gone red. We got this red shading in the background, which might be hard to see, but this red shading is telling us it's actually kind of overbought within a downtrend, even though it's broken and it's performing fairly well. There's a lot of mixed signals in the precious metal space. Gold and miners are trying to have this impulse move to the upside, but there's a lot of momentum. A lot of damage was done on these big drops, right? And so that's what we need to be aware of. As much as I want to be bullish and love to see metals push up and hit some all-time highs for one final big push, I'm not sure if we're going to get that. And we saw the miners get overbought yesterday. They are set to gap sharply higher, 106. They're trading at 106.28 this morning. So they're trading way up here. And I think we could see a big reversal and potentially some selling. So at this point, it doesn't look the greatest. Gap higher is not good, especially when the momentum is flipped to red and down in that space. And all the precious metal charts, even gold, you can look at them as a big potential bear flag that points to another leg down that will really wipe things out. So let's just take a look at gold real quick, just because I would like to see gold continue to push higher, but overall, this is still the same thing. This is a big down move. This is a counter trend kind of play as price goes. So big volume on the down move. As price moves up, we've got lighter volume, meaning it's going up with fewer and fewer buyers are excited to pay this pricing, and then it could break to the downside. And sorry, I got a system firing off some trades, some spikes here. But overall, if we step back, it's a big mixed market right now for precious metals. It's a coin toss. The long-term trends for metals, the long-term trends are still up. Price is still intact above the 50-day, the 150-day, all of that stuff. So short-term, they don't look healthy. Longer term, they're a pullback within a bull market. And so those are the mixed signals, and kind of you gotta let them digest and move. We did sell out a bunch of our position right up here near the highs for gold and silver, and now we're letting it digest and figuring out how we want to deal with the second half of our position in metals to lighten the load.
Gold and silver recently staged sharp rallies, yet short-term signals are mixed. Although long-term trends remain intact above key moving averages, recent price action resembles a counter-trend bounce within a broader consolidation. Volume patterns show stronger participation on prior declines than on current advances, a potential warning sign. Mining equities, despite early gains, are flashing overbought signals within vulnerable structures. A breakout remains possible, but failure could trigger another corrective leg. In volatile environments, metals can swing rapidly between safe haven demand and profit-taking pressure driven by shifting macroeconomic data.
If we take a quick look at the Mag 7, we talked about this the other day. It's bounced up into resistance, found some selling yesterday. The 30-minute chart, obviously the momentum is red bars, not good, but we do have a little impulse move. We got to move up. It's got a bull flag. Hopefully we could see them have one more push, finish the second half of this little bull flag. Hopefully the S&P 500 pushes higher, hits an all-time high, and also reaches one of our targets so we can lock in profits. And we're so close to hitting a target there and reducing our exposure. And then after that, I don't really care what happens. If the market rolls over and breaks down, Magnificent 7 breakdown, we could be on the start of either just a big 15 to 25% correction in the equities market, or we could go into the start of a massive bear market. Who knows? All the signs are there that a big pullback or the start of a multi-year bull market is on the cusp at any point. We've never been, I think, closer to one right now from over the past couple of years. We finally had the blow-off move that I saw in precious metals and silver, all of that stuff. That is kind of one of the key warning signs. And so now we're kind of just waiting for the music to stop and for the momentum to break, for everything significant, big stocks to break below support and the momentum to stall out. The NASDAQ is already on the cusp of breaking down as well, which the mags will probably drag it down. And I think that's about it. Let's take a look at oil. It is having a nice pop today. We mentioned it has this bull flag pattern. It is pushing higher and it looks like energy wants to keep going up here. So energy stocks have been doing very well. XLE, OIH, all of those have been screaming to the upside. They're big dividend paying stocks, which is probably one of the reasons why we're also seeing SPYD, like some of the big dividend ETFs move higher. REITs and energies are kind of surging. So that's about it for now. We'll see how the day unfolds and go from there. Actually, let's just take a quick look at the chart of bonds. Bonds this morning look like they just took a bit of a hit. So obviously, yeah, economic data is causing some moves. Now, just because we have a big move, or it's not that big of a move, just because we have a move on economic data doesn't mean the whole game changes or anything. We always get these spikes and moves. Economic data is just noise. The market usually the market goes in the opposite direction of whichever way it spikes. It's just funny how it always does that. So it's just shaking things up.
Energy markets are showing relative resilience. Crude oil is advancing from a bullish consolidation pattern, supporting gains in energy producers and related equities. Dividend-paying energy stocks are benefiting from both income demand and commodity momentum. Meanwhile, bond yields are reacting sharply to economic data releases, adding to cross-asset volatility. Markets today are balancing between record highs and potential structural fatigue. Whether this represents the final leg of a mature bull cycle or the foundation of renewed expansion remains unclear. For now, investors are watching support levels closely, waiting for confirmation before committing to the next decisive move.